let's talk about credit cards and increasing your credit limit. Before we get into it, I want to talk about the sponsor of this video, Aura. If you're like me and love saving money, you probably shared your Netflix password with your friends and family, and statistically, the average consumer has 90 accounts. It's most likely that you don't have 90 different passwords to go with each one. So if someone has one of your passwords, they probably have access to your other accounts. This can make you and your accounts extremely vulnerable to things like identity theft and fraud. And if you think that won't happen to you, just know that American consumers lost $56 billion from identity theft in 2020. And that's a lot of money. This is why I've partnered with the sponsor of this video, Aura. Aura is an identity theft protection, fraud monitoring, a VPN, password management, and antivirus software all combined in one easy to use app that monitors the dark web for your emails, passwords, your social security number, and quickly sends alerts right to your phone and email. I've dealt with fraud and I know with fraud, every second matters. I love Aura because it can connect my credit and bank accounts and notify me of any changes up to 4 times faster than Aura's other competitors. Aura's VPN allows me to stay anonymous online by keeping my browser history and personal info safe and encrypted. And the best part is that Aura's antivirus software will block malware and viruses before they infect devices. Aura found my personal information on the dark web 5 times in the past 2 weeks. So stay safe and start your 2-week free trial today at aura.com/justlean. Once you sign up, don't forget to comment down below how many times your personal info was found. Back to the video. Credit cards and increasing credit can be confusing, so in this video, I'm going to debunk some myths that I've heard about credit cards and their correlation to credit score. Now, myth number 1, you only need one credit card and getting more credit cards are bad. This is actually wrong. Multiple credit cards don't hurt your credit as long as you use them responsibly. It's actually better because you're lowering your credit utilization, and credit utilization is the amount of credit that you have. You should only be using 30% of your credit utilization to get that good credit. So the more credit cards you have, credit utilization gets bigger because you have, let's say, 5,000 on one credit card, 10,000 on one credit card, 15,000 on one credit card. That would give you $20,000 in credit. But if you only have one credit card, it'd be, let's say, $500. And if you use $400, that's over that 30% limit. So the more credit cards you have does not always correlate to having a lower credit score. And as a bonus, if you utilize your points on specific credit cards, you can also maximize rewards to get even more money back. Now, myth number 2, canceling your unused credit cards will help your credit. That's actually wrong. You actually never want to cancel your unused credit. This also goes with your credit utilization. Let's say you have $20,000 in credit utilization with all your credit cards, but one of them is $10,000. The moment you cancel that credit card, your credit utilization drops to 50%. If you spend the same amount of money, your 30% or less credit utilization will go up, which will in fact make your credit lower. Not only that, but if you cancel your credit cards, you actually minimize your history on your payments because you want to have a history on all your credit cards. So the moment you cancel it, that will disappear on your records and lower your credit score. So instead of canceling a credit card, maybe you have an annual fee on a credit card, you just don't want to pay the annual fee, probably call them and see if you can get a retention offer, which is basically if you can get any discount on the annual fee, or just ask them if they can replace that credit card with a no annual fee credit card in the same bank. Now, myth number 3, missing your payment will automatically affect your credit score. Yes, technically it does, but you know, life sometimes happens. So sometimes you may miss a credit, but here's where it gets really tricky. Here's the important part. Payment due dates after 30 days get reported to the credit bureau. So try and pay on time, as you are technically borrowing the bank's money. But if in chance you forget a payment, try and pay it before that 30 days, because after that 30 days is where you're going to see that big impact on your credit score. And on top of that, you'll have to pay that interest of whatever percentage that APR is with your credit card. It can be 15 all the way up to 30 or to 40, just depending on your APR, and you'll have to pay that on top of the balance that was due. Myth number 4, applying for a new credit card will hurt your credit score significantly. This isn't true. What hurts your credit score the most is applying for a lot of credit cards in a short period of time. When I mean by short period of time, in less than a span of 6 months. And this is worse if you have bad credit, because 1, the bank is going to be suspicious of why you need so many credit cards in a short period of time, and they're not going to trust you with that much credit. Not only this, but some banks will use a hard credit pull and not a soft credit pull, which means that when you do a hard credit pool, it stays on your account for 2 years, but they only consider it the past year. In turn, it will be on your record and it will just make it seem like you're a reckless user of your credit. You're just trying to borrow a lot of money from the bank. So if you need to get a credit card, let's say you've seen that your groceries have gone up in the last couple months, try and apply for a credit card every 6 months, not less. If you apply too quickly, it will show up on your records, but if you do it every 6 months, that means you'll have 2 applications and 1 should be the only one that shows up for the year, as banks only consider your past year. Now, myth number 5, you need to carry a balance to build credit. Yes and no, but it's actually really wrong. Carrying a balance can help build your credit, but here's where it's going to affect you the most. You're going to have to pay a high interest that's just really not worth paying. Remember how perspective, right now the housing interest rate is 5 to 6%, but credit cards are going to be around your 19 to 30 to 40% APR, which means that if you have $100 that you haven't paid off and you're going to carry that as a balance, the next month it's going to be $130 or $140. On top of that, it's going to be compounded by that amount. So you really don't want to carry a balance. As much as people say that it will help your credit score, at the end of the day, is it worth you paying that $30, $40 every single month more and compounded more and more every single month for that 5-point credit increase? Instead, just get a car payment or a mortgage or any personal loan. That's probably way better, as you'll be having a record of how many payments you do for the certain amount and that you always pay those loans. Now, for those of you who have a strong belief that carrying a balance is correct, just make sure that you keep it low. When I mean by low, try and keep it like $2, $3. That way, when it does get to the next month and you do have to pay interest, it's not a big deal as having to pay $30, $40 extra dollars. And it's always better to keep your payments on time every single month. That way you can keep your credit score in check. And remember, with everything being said, to build a healthy credit history, pay attention to the factors that go into calculating your credit score. Components of the FICO score, for example, are divided into 5 categories. One, the biggest one, is going to be your payment history, is how many payments you have, how many credit card histories you have, which is why you never want to close your credit cards. Number 2 is going to be amount owed, and payment history is about 35%. Now, amount owed is 30%, so you want to keep this as low as possible. You don't want this to be as big, because then banks will be worried about how much money you owe to the bank, and in turn just drop your credit score a lot. The term of your credit history of 15%, which is how long of a credit history you have of, when you open your first credit card and how long you've kept it till now. 4th category is new credit cards, which is 10%, showing how many credit cards have you opened the last year, and it's not going over where you are trying to get as much credit cards in a short period of time. And the last category at 10% also is going to be your credit mix. And credit mix refers to how many credit accounts you have. This can be car payments, mortgages, credit card accounts, and stuff like that. So with that being said, those are your 5 myths debunked. And make sure you guys, keep track of your payment histories, the amount owed, the length of your credit history. Try not to apply for new credit cards as much, and make sure you have a credit mix of everything, including your mortgage, car payments, and your credit accounts. With that being said, I hope you guys enjoyed this video. If you thought it was informative, make sure you guys like and subscribe to this video. Don't forget that 2-week trial with Aura at aura.com/JustinLee. I'll see you guys in the next video. Peace.